I think as you see, I think you said 400,000 people coming into the country in 2022, they are going to need a place to live. And to quantify that, the 8th largest city in Ontario is 400,000 people. So you're talking about that amount of people coming in and needing a place to live on top of an already extremely hot market. I think, when the floodgates open and people do start to come in, that is going to drive the need for housing, at least affordable housing, up in 2022. What is going to happen in regards to economists speaking about 2022, they're expecting in Q4 that the Bank of Canada is going to change their overnight lending rate. The Bank of Canada did say that they were going to start in 2023. They've now changed that because I think we're on a better trajectory as an economy at the moment. So Q4 2022, they're planning on something happening with the Bank of Canada changing their overnight lending rate. That is going to affect prime, which is then going to affect your variable rate on your mortgage. And if you take a look at history and how the Bank of Canada has increased rates over time in situations like these, it's usually not once. It's usually a quarter point, a quarter point, a quarter point. And your variable rate mortgage can very well become an extra percent very quickly.
What is up, YouTube? Matt McKeever here, and we've got Josh and Ehren from the Findlay Mortgage Team, and we thought we'd maybe go in a slightly different direction than a lot of our normal YouTube videos. So today, we're going to be talking about what it's going to be like buying real estate in 2022. But for context sake, I should let you know it's July right now, 2021. You can tell because Ehren's got shorts on. But otherwise, just want to give that context because no one's got a crystal ball. We can't predict the future. No one can. But I think there are certain trends and probabilities that we maybe feel comfortable exploring here that we think a lot of real estate investors should have on their radar if you're thinking about buying either in the second half of 2021 or you're thinking about buying in 2022. So what comes to mind when you guys are thinking of buying properties in 2022?
Well, predominantly every single conversation I have with an investor who's closing in the next 30 to 60 days, what's going to happen? Like next year, what's going to happen? What rate should I choose? Variable, fixed. What do you think is going to happen with the market? Where should I invest? What type of assets should I invest in? And as you said, we don't have a crystal ball, but if we take a look at what economists are saying, we take a look at past history and what's happened when we've moved out of recessions, what's happening with our political landscape, immigration. There's a handful of things we can look at that are going to give us an idea as to maybe what that landscape is going to look like in 2022. And for anybody who's looking to buy now, you're probably looking to see what's next year going to look like. Am I going to be buying single family homes, duplexes? Where am I going to be parking my money? So all the investors who have that hindsight or foresight to be able to look into the future, who's planning next year, this video is for you.
Yeah, I was just thinking, one thing to take away from this also, not just necessarily what we say, but things to be looking out for on your own and doing research, increasing your own knowledge and being able to start researching market trends and government topics and, without having to listen to our videos, figure out for yourself, hey, based on the bond market or the Bank of Canada overnight rate, should I be, just some things to be keeping in mind and write down to be able to just look at every single year and how is this going to impact my investing moving forward.
Yeah, so number one thing, as everybody knows, inventory is low, demand is still high. We just went through extremely large bull market in the last 12 months. The valuations have increased drastically. We are seeing a little bit of softening in the market right now. I think obviously you needed to plateau or at least soften a little bit after what we saw in the last 12 months. Is that situation going to change by 2022? Probably not. Inventory is still low, demand is still high. I think that the government is going to have to do something in regards to maybe reducing some of the red tape to allow developers to be able to open up the floodgates and start developing. Right now it is extremely expensive and time consuming to be able to go through the process to build or develop in any primary market right now. Toronto is ridiculously expensive, takes forever to be able to get permits. Kitchener, Waterloo, Cambridge, Guelph, London. It's taking quite a bit of time and quite a bit of capital to be able to, allow people to create higher density buildings. So I think that the government is going to have to create some sort of legislation or open up the floodgates a little bit to allow people to start creating that multifamily to kind of combat the low inventory environment, because right now there isn't enough houses, and that's why prices are driving up.
Yeah, I mean, the only option right now is that infill type development, which can be a little more maybe not as costly as a full development, but for the average investor who's maybe just looking at flipping and burning to move into some sort of demolishing of a building or maybe a lot and clearing it out and developing some sort of medium density, that's really your only option right now in terms of creating overall rental units. Like Josh said, like annexing right now isn't possible, or it requires a special exception if need be. When you take a look at just basic supply and demand, that's one of the basic things that's going to increase the cost of land and the cost of buildings if the units that aren't available and the demand is there. Even just from a development standpoint, if a developer is looking for land, infill developers are looking for land, and that land isn't as readily available, as a homeowner, I see my land and my house being worth more because this developer wants to come in and buy it off me so he can raise up a small, medium density type apartment building. So there's a lot of costs that are going into it. You take a look at the cost of wood and the cost of materials to build right now. Even for developers who are building these townhome developments, their margins are based off of their cost to build. So when you have a higher cost right now, the developer can't sell that townhome for $450,000, $500,000. It automatically becomes a $700,000, $750,000 building. So understanding the cost and the economic factors of that, and how those play into those costs and the cost to buy.
Yeah, I think in regards to demand, I think we spoke about it previously to shoot the video, is immigration. So COVID's halted a lot of the immigration into our country, and we are a safe haven for a lot of refugees. We are one of the best countries in the world to live in, and immigration plays a huge factor in the housing market in general. So I think as you see, I think you said 400,000 people coming into the country in 2022, they are going to need a place to live, and to quantify that, the 8th largest city in Ontario is 400,000 people. So you're talking about that amount of people coming in and needing a place to live on top of an already extremely hot market. I think when the floodgates open and people do start to come in, that is going to drive the need for housing, at least affordable housing, up in 2022.
Yeah, and I think just to paint both sides of this picture here and what it's shaping up to be right now in the present July 2021 right now, there's not a single market in Ontario, Canada, to the best of my knowledge, that has greater than 6 months worth of inventory sitting on the MLS. In fact, I think that the vast majority are under 4 months. Now, depending upon who you talk to, some people will say the balanced market starts to occur at 4 to 6 months. Some people will say it's closer to 8 months, but probably somewhere in that 4 to 8 month range. Whereas a seller's or a buyer's market doesn't really start happening, in most people's opinions, until we're at 10, 12 or greater months worth of inventory. So essentially what we would need to see in order for supply to catch up to where demand currently seems to be is we'd either have to have essentially kind of everyone stop buying for 10 months and we'll get into a position where we're now in a buyer's market, or we're going to have to see a lot more properties come on the market. And right now, there's just no reason to see a catalyst for either two of those factors, in my opinion. And then when you add on the fact that, hey, real estate skyrocketed almost across the board by 25% over the last year in Canada, and that was during some of the lowest immigration we've ever seen. And now we're looking in 2022 the highest amounts of immigration. My understanding is over 400,000 immigrants compared to pre-COVID levels of around 185,000. Well, that seems like the perfect recipe to see demand continuing to outstrip supply. And as you guys mentioned, it's difficult to just get new supply when it comes to houses, whether we're talking about apartments or whether we're talking about single family homes or somewhere in between. Because again, there's a long lead time. So even if all of us investors decided that building new units was the best investment option available to us, we're probably looking at anywhere from 12, 18, 24 months before the start of that push we'd really start to see coming online. So again, it seems unlikely that we're going to find any solutions in regards to pricing right now or affordability when looking at either immigration or just supply and demand, right?
Yeah, and another thing that doesn't necessarily help affordability is just some of the barriers to get into the market as a borrower is, what does the stress test look like that everybody has to qualify with? And recent changes, I think it was June 1st, where it went up from 4.79 to 5.25. Not a huge change, but maybe that 5% of the population that was sitting on the outskirts of being an A lender or getting approved as an A lender maybe now went to a B lender, or maybe just now aren't being approved at all. So, marginal, but it does still have an impact, especially probably coming out of COVID too, which is another thing, is what is the income going to look like next year? When you take a look at most people who are going to be business for self, you're going to be going based off of some sort of 2-year average. COVID was definitely around for 2 years. How does the business income going to take a look like that? For those who were laid off, maybe having troubles finding employment, getting back into full-time work. If you're hourly right now, and those hours aren't guaranteed, you're going to need a 2-year average of being at that employer. So, what is the employment situation going to look like coming out of COVID as well, and how are the small businesses going to be affected, and ability to just show income and qualify at a higher stress test rate. Going to be interesting to see how the economy recovers from that standpoint as well.
Completely agree. I know a lot of banks are looking at a 3-year average right now, moving into finding, once everybody gets back to work, how do we accurately reflect somebody's actual employment? Because last year obviously wasn't an accurate reflection. If you were in a service industry, or you were in an industry that was shut down, is it fair that because a black swan event happened, you can now not afford a home? So I think they're finding solutions that are going to try to help people qualify, like maybe taking a 3-year average instead of a 2-year average. But we do see quite a bit of people are going to be affected from a qualification standpoint for qualifying for properties, especially if your hours aren't guaranteed.
Yeah, another thing that comes to mind just talking about that is debt. For those who start to rely more on lines of credits and credit cards, just obviously doing your best to make sure you pay that down as fast as possible, carrying that debt, if you were laid off, if you lost your job, unfortunately, and had to rely on those sources, those are going to play a big part of your ability to afford a house down the road as well. So just doing your best to get those paid off as quick as possible. Speak to professionals before you jump into a consumer proposal or some sort of bankruptcy if you're considering that or you're at that point. Make sure you fully understand what that's going to do for you. When you take a look at a bankruptcy, it's going to be on your record for 7 years, and you're not going to be able to get into that A lending. Is that worth you not being able to get into an A lender for the next 7 years? So just understanding the repercussions of that and what other options you may have. Really take a look at everything before you make those decisions coming out and trying to clear up your debt.
Yeah, because those could be serious life-changing decisions. We see people who take a consumer proposal for $15,000. Like, don't do that. Go get a side hustle, pay it off. That will follow you as a serious credit delinquency for like 6 years. It doesn't matter, if it was just a few $1,000s. Like, that shows to a lender that you do not have the capacity to be able to even service a small amount of debt. So, definitely, obviously you're going to speak to a professional when it comes to doing debt consolidation, but maybe speak to your accountant, speak to a mortgage broker, have a few perceptions of that specific situation before you start pulling a trigger on something that's going to affect you for quite a long period of time. One of the questions we get every single day, all day, fixed or variable. Now, everybody knows the advantages and disadvantages of a fixed versus variable. One has a little bit more flexibility, variable with a 3-month interest penalty. One is fixed, it has an IRD, which doesn't allow you to have as flexible terms when trying to restructure your debt. What is going to happen? As everybody knows, fixed rate has increased while variable rate has stayed decently stagnant. You're around prime -1, prime -0.95 right now. You're still in the ones for variable, which is phenomenal. It's the cheapest money historically we've ever seen. What is going to happen in regards to economists speaking about 2022, they're expecting in Q4 that the Bank of Canada is going to change their overnight lending rate. The Bank of Canada did say that they were going to start in 2023. They've now changed that because I think we're on a better trajectory as an economy at the moment. So Q4 2022, they're planning on something happening with the Bank of Canada changing their overnight lending rate. That is going to affect prime, which is then going to affect your variable rate on your mortgage. And if you take a look at history and how the Bank of Canada has increased rates over time in situations like these, it's usually not once. It's usually a quarter point, a quarter point, a quarter point. And your variable rate mortgage can very well become an extra percent very quickly. So just understanding what that could do to your portfolio. If you are just riding the line on cash flow for a property, if you're buying property for appreciation in Toronto and you don't have any cash flow, what does that variable rate mortgage do to your cash flow situation? Especially if you have 3 or 4 of them. It's great you're making appreciation, but you might be underwater. So understanding what's going to happen when the Bank of Canada does hit their inflation target and the economy starts to recover and we start to move into a situation where the Bank of Canada does start increasing rates. If you have an entire portfolio of variable rate mortgages, this will affect you. So, making a decision right now as to what rate or type of rate you want on your mortgages, that looking into the future is going to affect your ability to be able to invest in the future if you're focusing on cash flow.
Yeah. And like the Bank of Canada did have some programs in place to help those credit lines and that the overnight lending rate stay competitive, but those in the past few months have now been stopped. So there's signs that are out there that they're moving back into a normalized economy. And you take a look at the banks are businesses, so they're going to want to increase their margins on these lending rates. The money that they put out, they're going to want to start making more profit on that. So, there's more signals that lead to the rates going up than there are rates staying competitive. There might be some people out there who talk about trying to keep interest rates a little bit lower to offset some of the cost of inflation and being able to pay off debt. But even, marginally, I think there's going to be at least some sort of small increase in the rates moving forward. Even if it's not a large increase to keep up with inflation, there's going to be some sort of increase marginally just to get the banks back on track and building those margins up. Because the last thing a government wants to do is have to come out and try to bail out banks that are, riding on small margins, right? So there's going to be some sort of padding done for the banks to increase those margins.
Mm-hmm. Yeah, and I've said it before, guys, and this is just my hot take, but I always feel like I'm at a wedding because there's doves everywhere. In my opinion, there's not a single hawk amongst central bankers. That's just my hot take on the situation. But again, it will be interesting to see. Obviously, inflation right now is just transitory, so there's no pressure on central banks currently. But what will the future hold? No one has a crystal ball, but it certainly seems more likely that if you were to ask me, will interest rates be 1% higher or lower than they are today? It seems kind of practical to assume it could only go one way, but again, we've already been through a couple black swans. We'll see what the future holds, but I think the bigger point here is how does it impact you in your exact portfolio, right? Because it's fun to talk about this theoretically, but as Josh was saying, it's actually like, how's this going to impact my portfolio? Am I riding just the thin margin line right here? Because if I am, maybe I should actually start looking at locking in things, and even if it's going to put me in a slightly bad cash flow perspective, at least that's maybe a known rather than an unknown.
Completely agree.
Yeah, and those variable rates, as they increase, it's going to decrease your affordability over time as well, because that will reflect when we take a look at your personal debt servicing if you're still looking at A lender or B lender type mortgages. So, when you're looking at qualifying for a property based off of income, cash flow, and your mortgage payments, if your mortgage payments are going up month after month for the next, few years, not a few years, but going into 2022, that could also play another part in decreasing affordability as well. So it all adds up, right? It's small things left, right, and center that over time really have a huge effect and kind of take a cut out of your ability to grow and increase your portfolio moving forward in the next few years to come.
Mm-hmm. I don't think that the Bank of Canada, the federal government raised the qualification rate for no reason at all. That increase in qualification rate, I think possibly was to try to calm down the market, but I think they're also getting ready. I think they're putting some safeguards into effect to allow for people to, or understand that people can actually qualify for the loans they're about to be in. So if interest rates do get to, say, 3%, 3.5%, 4%, can these people truly qualify for the loans and pay for these loans? The last thing you want to do is to have an economy start recovering and interest rates start to go up, and then everybody can't afford their homes. Mm-hmm. So I think the government is getting ready for it. Obviously speculation. I don't sit on these insider meetings and understand exactly why they do what they do, but that increase in qualification, some the people who are entering the market see it as obviously a negative. It's harder for them to get in, but I think it is a good safeguard to have as an economy. It allows for people to actually afford the homes that they're in. Moving into 2022, obviously the house prices are higher, the qualification rate is higher, the barrier to enter the market is higher. So first-time home buyers are going to still have a difficult time, getting in to a property. There is CMHC and Sagan now. You can't have an insured mortgage product, so there are ways to get into the market, but it's just becoming increasingly more difficult for people to do that. As we see investors in 2021 transition into 2022, a lot of investors are moving away from single-family homes. Anybody who is buying a single-family home can't make any cash flow anymore on purchase. The valuations are so high and the income on these properties is so low that last year you weren't allowed to raise rent. This year it's marginal, you can hardly raise any rent. So you're having a hard time with any sort of individual cash flow on single-family homes. So everybody's moving into this multifamily space, which has caused obviously a drastic increase in any sort of multifamily in the primary markets at the moment. So what's happening is, for anybody who's looking to buy commercial real estate, valuations have increased, rent has stayed the same, and if we're qualifying the loan based off of rent, you can no longer qualify conventionally for these buildings anymore. So we're seeing a huge shift in the type of financing we're having for these buildings. So any investor who's qualified or is looking to transition their portfolio to cash flow and move into multifamily, understand that you now need a lot more money to get in to qualify conventionally, or you need to close privately. So to be able to turn over the tenants, reposition the property, and then move into conventional financing. The banks love this type of real estate, but it needs to be operating at that level. So understanding the challenges involved in moving as an investor to try to get cash flow in multifamily properties, you might not be able to afford a primary market. You might not be able to afford Kitchener, Waterloo, London, Toronto. Moving into those Chathams, Sarnias, Windsors, we're seeing a lot of people try to gobble up as many units as possible at a low price point because they're still qualifying conventionally. And I think as you see 2022 progress, you're going to see that it's going to be increasingly more difficult to purchase multifamily property.
Yeah, and without getting too deep into the subject matter, because I know we've done whole videos on it on my channel, but I do think that markets that have a decent economic picture, so like let's pick a Chatham, Sarnia I think has a great economic picture, but it's another good example. I think we're going to see more and more investors flocking to these non-primary markets, tertiary markets, smaller markets, simply because I think if we look at where society's going, where government policy's going, ideas like UBI, universal basic income, seem to be gaining more and more traction. And whether you agree or disagree with it, and again, I've done a bunch of videos on the subject matter, but regardless, when we look at it just as an investor, usually the way this shit works is they roll it out on a province or nationwide basis, and that means that the same person, whether they're living in Chatham or they're living in downtown Toronto, they're likely going to get the same UBI. Now, obviously, the cost of living is significantly higher in Toronto versus Chatham. And as an investor, if we're looking at a $2,000 a month UBI, the average Canadian spend 30-40% of their income on shelter, means that person could be spending $600-800 of that UBI on your rent, right? And so when we're looking at that compared to what the person in Toronto could afford to spend, well, it seems like a no-brainer that there'll be more money sloshing around chasing apartments in Chatham than there will be in Toronto, because that $600-800 a month, not going to make a dent in Toronto because there was no inventory at that price point anyways. Whereas in Chatham, hey, yeah, there actually is still inventory. You could still get a shared room or a bachelor apartment in that price range, likely in the Chatham market. Whereas Toronto, nope, you're already priced out. You probably can't even get a shared room at that point.
Yeah, no, it's a great point, and just again, having the knowledge to think of these factors and be able to sit down by yourself and start analyzing these things and what types of things are coming up, government policies. You guys are going to be a huge conversation for a while to come, I think. But as an investor, like you just said, where am I going to have the best success rate and be able to maximize these new policies that are coming in? And as your job as an investor is to fill your properties, where are you going to be more successful filling your properties? In a market like Chatham, where people are going to start to push to Windsor, London, or as people graduate away from the GTA, that's essentially going to start being your hot spots to start purchasing and setting that shop and just waiting for the tenants to come by and be looking for units to rent out.
All right, guys, so we're going to be wrapping up the video shortly here, but I thought we'd ask one last question. So it's July 2021 right now. If you've been paying attention, across the board in Ontario, Canada, we've seen year-over-year average price increases of about 25%. That's across the board. Now, that's not normal, but I thought it'd be fun to hear from myself, Josh, and Ehren what our thoughts and predictions are for the year-over-year increase from July 2021 to July 2022. So do you guys want to go first? Should I go first? Who wants to be the one that goes first here?
I want to hear you.
Okay, so we've seen a 25% year-over-year increase. It's insane, it's not sustainable, and yet I'm going to predict we're going to see prices higher in July 2022 versus July 2021. And I'm going to say that year over year, I think that inflation is not transitory. I think that doves live amongst us. And I'm going to say like a 15%, which I don't even think it should, but I think it will.
I'm on the same train. So I think that the increase in demand is still going to be there. I think that inflation is going to still run rampant. I think the QE that's happening right now is going to require inflation to hit decently high numbers. I think that you're probably going to see, I'm saying 7 to 8%.
8%. Yeah, I think it's just basics, supply and demand. There's way too many factors that are going to keep increasing housing costs. Inflation or immigration coming in with the amount of people, 400,000, cost to build. How does wood stay? How does things kind of play out that way? Do we see more of a shift to concrete? Who knows? What are government regulations like around development moving forwards? I wouldn't be surprised if we're sitting around like that 12 to 13% increase year over year. It's not going down. I mean,
We'll find out, but I'd love to hear from you guys, your thoughts, your opinions. Jump in the comment section. Let us know which one of us do you agree with, or what's your prediction for the next 12 months. We'd love to hear, but otherwise, if you guys want to get in contact with Josh or Ehren, we're going to have links in the video description down below to all their contact information. Really encourage you guys to reach out, but a reminder, none of us has a perfectly working crystal ball. So if you're hoping to get a commitment from them on a mortgage for, July 2022, I don't think they're going to be capable of doing it quite yet.